Hello, good morning to all. Welcome to a brand new week ahead. This is Kelvin here, the senior market analyst of OANDA Asia Pacific. Welcome to today's daily dose of market insights. Today will be Monday, the 4th of March, 2024. All right, so before we jump straight into our usual daily dose of market insights, let's take a look at the disclaimer slides first. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump straight into the short-term technical outlook on the various cross-asset classes, let's take a look at the events and key economic data that has taken shape on last Friday, and as well as the impact on the various cross-asset performance. Let us start with the economic data first. All right, so in terms of economic data, what we have on last Friday, let me share my screen over here. Okay, good. So on last Friday, we have this rather important key US leading economic indicator called the ISM Manufacturing PMI. I would say not really that significant, but it does have an impact on the broader market, especially on the manufacturing prices, because they do have a various subcomponent in this ISM Manufacturing PMI data release. So the headline number actually came in below expectation. Markets are just expecting 49.5. It came in at 47.8, also below January print of 49.1. So if you look at the trend of the headline manufacturing PMI, what we could see over here is rather okay, you look at the 5-year trend, it's actually rather lackluster, below the 50 level mark since late 2022. All right, below 50. So anything that's below 50 is actually indicating to us that the manufacturing sector in US is actually in the contracting mode. But not to worry. Why? Because we're talking about, some of us may argue that the US is on the brink of a potential recession. But however, manufacturing is only a significant lesser portion that is driving the US economy, but most importantly, the US economy is being driven by the services sector instead, which is, I think, made up close to, I think, 2/3 of the economy. So that's why the ISM services is much more important rather than the manufacturing. But what's important in the manufacturing over here is the subcomponent, which is the prices. All right, so why is it important? What's prices? Think of it as prices as something like a producer price index, where despite the fact that we know that businesses require raw materials to run either indirectly or directly, from a perspective of, even though I'm doing a services provider. So as long as these manufacturing prices remains capped, there is a lower risk of inflationary expectation being spilled over to the wider US economy. So what we see over here is that the ISM manufacturing prices, right, it came down below the previous month of 52.9. It came in at 52.5 for February, and also below expectation of 53. So if you look at the trend of the ISM manufacturing prices, or something like indirect gauge of producer prices over here, if you look at the 5-year trend, all right, it's inching upwards, but but it didn't break above the previous high of around the 53 level mark. All right, so what you could see a bit consolidation is more like a sideways range right now. And also last month, latest print of February came below expectation of 52.5. So that actually implies to us that inflationary pressure in US is still remains capped at this point in time. That means, i.e., there is a lower risk of a potential feed through through the potential, what I call inflation feed through towards the wider economy, that keep the ongoing Fed pivot alive, as indicated by this ISM manufacturing prices paid subcomponent for February. So that is what actually explain given the ISM manufacturing prices being paid, these subcomponents that came in below expectation, that actually causes the US 10-year Treasury yield, I want to flash you all right now, to inch lower. Okay, to inch much lower. So the US 10-year Treasury yield inched pretty much lower on last Friday, 4.18%. And it's very important. Why? Because right now it's actually attempting to break below the 200-day moving average, which is right below a key near-term support level at 4.14% that I have been highlighting since 2 weeks ago. And as long as prices remains lackluster below the lower limit of the major resistance zone of 4.33%, which I've highlighted as well, that could actually be supportive of the ongoing short-term to medium-term bullish trend that is still intact in the major US stock indices and as well as the rest of the world. Okay, for some reason, the Hang Seng Index, because due to China deflationary risk structure issue, is more evolving like a short-term counter trend rebound scenario rather than the start of a medium-term uptrend phase. Okay, we'll touch more about that later on the Hang Seng Index when we go into the short-term technical outlook on that index. So for sure over here is that it's actually getting lackluster or sluggish below the 4.33% resistance level for the 10-year US Treasury yield, which implies also a potential lower cost of funding going forward. Okay, that is also conducive for a risk-on environment. Okay, so that now in terms of the major US indices, all the major US indices last Friday closed in the green, that means positive, where both the SPX, Nasdaq, and these two indexes managed to rally fresh all-time high again. The top performer being the Nasdaq 100, up 1.44%, the SPX 0.8%, the Dow Jones Industrial kind of lackluster, but managed to have a gain of positive 0.2% last Friday, and the Russell 2000 added 1.05%. So what you could see over here in terms of the heat map on the S&P 500, if you look at it over here, what we could see on last Friday performance is also pretty much driven by the mega cap stocks, especially in the semiconductor space, where the AI optimism continues to lead the fort, with Nvidia gaining 4.4%. And if you look at the entire semiconductor sector, is the one that is flashing the most in terms of the lightest green. Okay, anything that's lightest green, that means implied that they are actually the top performer sector among the technology and among against the rest of other sectors and component stock in the S&P 500. And also during the close of the session, the S&P 500 added on another AI stock, which is I think microcomputer. Let me share with this is super microcomputer S&P 100. Okay, so actually this super microcomputer, okay, it actually added on last Friday at the close of the US session, the index compiler decided to actually add this super microcomputer stock to be part of its S&P 500 component stock. All right, so that is also kind of a, we call it leading to this positive feedback, positive loop into the AI optimism play that is leading the fort in the major US stock indices. So is it getting very overstretched right now on the major US indices, especially the Nasdaq 100? Well, later I'll share with you more in my short-term technical outlook on the Nasdaq 100 right in a short while time. All right, so then let me continue right now over here. So what we're seeing over here is for the spot go. So for spot go over here, very interestingly, spot go also staged a stunning rally on last Friday. Give me a minute. Where is spot go? Okay, let me on spot. Yeah, this spot go. So spot go on Friday itself, it added a gain of 1.88%, and this gain of 1.8% is the most in the last 2 weeks. And in fact, if you look at from a weekly perspective, this is the weekly chart. It broke out above the 2075 level, this previous swing high area of 25th of December week. So for the whole of entire last week, it added in 2.33%, and this 2.33% is so far the ongoing weekly gain that is the highest year to date, and as well as in the last 3 months or so, because the previous strongest weekly gain was 3.46%. That was for the week of 27th of November. So you look at for the week of 27th November until last week, last week gain was the highest year to date in terms of a weekly basis, and as well as the highest based on the past 3 months. So all in all, it seems to me that gold itself right now is potentially resuming this bullish impulsive up move within this major uptrend phase that I draw from the low of September 22, this light turquoise green channel over here as on my screen. So what we could see over here is that more likely the reason push up from 4th of December, the all-time high, and it starts to sluggish in the last we call it 2.5 months, 2.5 months or so, or there about 2 months or so. So it seems to me that the 2 months consolidative phase it's more or less has already ended, and right now, given last week very strong impulsive price performance on the spot gold XAU/USD, the probability seems to be right now skewed higher towards the bullish camp. That means, i.e., for the start of a potential impulsive up move within this major uptrend phase for spot gold that is still intact since the low of 28th of September 2022 that I draw in this ascending turquoise channel. Right, so this is the weekly chart for gold. So later I'll share with you more on the short-term technical outlook. That means we talk about from a 1 to 3 day perspective, what are the key levels to watch out for. Okay, so with that, that pretty much sum out for, okay, and one more news to share over here is we talk about oil price. So for oil price over here, OPEC actually extended oil cuts over the weekend during the OPEC Plus meeting with Russia, boosting its efforts to actually curb supply further. So the group intended to extend 2 million barrel a day curbs until June. All right. So with that, oil supply seems to be pretty much tight right now. And also do not forget over here is that given the ongoing conflict in the Middle East, especially due to the fact of that Israel and Gaza ongoing mini war that has, I mean, no clear signs of, we call it ceasefire. Yes, we may have some media reports saying potential ceasefire taking place in the last 2 weeks or so, and even over the weekend, there was actually talk saying that there could be some ceasefire. But until we have much more clarity, geopolitical risk premium is still pretty much positive or high right now, arising from this ongoing Israel and Gaza conflict. Unfortunately, no signs of ending. So that could actually seize, we call it a potential number one upside for gold for sure. So gold is also benefiting in this ongoing geopolitical risk premium as well, and as well as for sure we talk about crude oil price as well. So for crude oil price, right, very interestingly, this is West Texas oil. So West Texas oil on last Friday managed to clear above a key medium-term resistance range resistance level that is in place since January this year at 78.40, was tested 1 time, 2 time, 3 time, 4 time, and on last Friday it managed to stage a clear breakout above 78.40 level, also right above the 200-day moving average as well. So the key thing for WTI West Texas oil right now, there could be a risk of it surging potentially to retest the major resistance zone, major range resistance at 93.40/95 that was actually hit on 25th of September. And during this period of time when gold rally, when WTI rallied to this area over here, it causes a weakness on the major US stock indices during this period of time, from October to, I mean, in the Q3 of last year. Okay, so if WTI price going to rally, right, that could be a potential headwind or a potential drag on the ongoing risk on behavior that's being seen on the major US indices. Why? Because oil prices, okay, it seems to me that some of us can't hear it. Let me do a mic test. Test. I hope that everything is good right now. Um, All right, so let me continue. Hopefully the volume is back. So what we could see, what I explained over here, oil prices is important because oil prices is a leading element for inflationary expectation. So if oil prices going to rally up, given the break of this 78.40, this ongoing risk-on behavior in global equities, especially in the US stock index, major US stock indices, could take a breather going forward due to the leading and lagging effect. So we got something we got to monitor going forward. All right. Okay, so with that, that pretty much sum up the key events that I want to highlight for you all, and how does it interplay from a longer term perspective and a medium term perspective in the cross asset classes. All right. Now, let us jump straight now to the short-term technical outlook. The main short-term technical, we'll talk about the 1 to 3 day basis on the major cross asset that we tend to cover daily. So let us start with the the FX market first. So on the FX market, for sure, dollar gets weaker on the weaker as well on last Friday. So you see on last Friday, the dollar index managed to close down weaker at negative 0.25%, attempting to test the key near-term support and the 200-day moving average at 103.70. So that actually also being triggered by the lackluster performance on the US 10-year US Treasury yield that is getting rather sluggish in the last 2 weeks below the 4.33% key resistance level. So with that, let us start on the euro dollar. So euro dollar managed to inch higher and recaptured the 200-day moving average on last Friday. So for sure, the 1.0810 short-term pivotal support level will be key. So that will be the level to maintain our short-term bullish bias for the euro dollar as long as 1.0810 holds. First resistance level to watch will be the previous, the 22nd of February minus swing high area, confluencing with the 50-day moving average closely as well, that is acting as a resistance at the 1.0890 level. A break above 1.0890 level exposes the next intermediate resistance zone at 1.0935 slash 1.0950. Only an hourly close below 1.0810 will negate this short-term bullish bias to see another round of a messy minor counter trend, a minor corrective decline scenario towards the next near-term support zone of 1.0785 slash 1.0760. All right, so let me expand my screen so that you guys could see much clearer. Okay, let us move on to the sterling dollar. So for the sterling dollar over here, what we could see is that the sterling dollar continue to hold above the 20-day moving average, and as well as the short-term pivotal support that we highlighted earlier as well, 1.2610. So as long as 1.2610 holds, we'll still maintain that short-term bullish outlook on the sterling dollar. First resistance to watch for sure will be the 1.27 figure level. That is this minor range top that is in place since 22nd of February. A break above 1.27 figure level exposes the next resistance level to watch will be at 1.2740 slash 1.2760. Only an hourly close below 1.2610 will negate this short-term bullish bias to kickstart another round of minor corrective decline scenario to expose the next near-term support level at 1.2560 slash 1.2540, which confluence with the 200-day moving average, as well as the minor swing low of 14th of February. Now, Asia Pacific currency, let us start with the dollar yen. So dollar yen, no change, continue to be range bound, but still managed to be kept below the 150.70, 150.80 short-term pivotal resistance that is in place since almost 14th of February. So no change, still maintain that short-term bearish bias within this range bound configuration, short-term range bound configuration for dollar yen. First support level to watch 149.60. A break below 149.60 exposes the next near-term support level at 148.80 slash 148.40. Only an hourly close above 150.80 will negate this or invalidate this short-term bearish bias to see a squeeze up to test the major resistance zone of 15140 slash 15195. All right, so the RSI also attempting to actually inch downwards again below the 50 level, indicating to us lackluster upside momentum right now for the dollar yen. Aussie dollar. So Aussie dollar last Friday we have a neutral bias. Why neutral? Because of mixed element, and as well as the rest of the other major pair is showing a short-term dollar weakness. So Aussie dollar on last Friday did a push up and break above the 65.30 level, and that's the upper neutrality zone, and as well as managed to recapture the 20-day moving average as well. And so far, at the start of today's Asia session, it managed to actually help slightly above this 20-day moving average level that is acting as a near-term support at around 65.20 mark. 65.20. So I don't want to tie it so tight at 65.20. I will use last Thursday as well as last Friday swing low area corresponding to the 28th of February swing low area. Seems to be like three minor swing low that's being tested, forming a bit of a minor triple bottom, okay, at 64.90. So 64.90 short-term pivotal support for today for the Aussie dollar. Flip back to a short-term bullish bias, with the first resistance to watch will be at 65.60/65.80, conferencing with the 200-day moving average, and as well as the minor swing high area of 20th of February to 23rd of February. Okay, that refusing that does not have a clear breakout above 65.80. So this will be the next resistance zone to watch, near-term resistance zone to watch on the Aussie dollar, 65.60, 65.80. So flipping to a bullish bias as long as 64.90 holds for today on the Aussie dollar. Only hourly close below 64.90 will invalidate this short-term bullish bias on the Aussie dollar to see another round of a rather choppy minor corrective decline scenario to expose the next near-term support at 64.70/64.40 level. All right, so net overall, we will start. It seems to us that in terms of from a technical analysis perspective, we start to see a short-term dollar weakness coming back into the FX market. Okay, major stock indices. So now let us start with the all right, with the Nikkei 225. Okay, so Nikkei 225, if you still recall, last week we were bullish, and last Friday the price action starts to actually swiftly move up within our expectation, almost hit the resistance level that we highlighted as well, 40,490, 40,690 Fibo extension level, and close to the upper limit of this medium-term ascending channel that I drew from the low of 4th of Jan. And what's interesting over here is that price action shape a higher high, coming close to our key short-term resistance that we highlighted on last Friday, which is almost hit already, and we start to see exhaustion signs for the boost by this bearish divergence that is being flashed out on the hourly RSI despite price action doing a higher high. So what we could see over here is that the Nikkei 225 or the Japan 225 right now is actually due for a minor corrective pullback scenario within its short-term uptrend phase that is still intact. Why? Because price action is still trading above the 20-day moving average. So what we could see right now is a minor corrective pullback to retrace this very steep impulsive up move that we see in the last 2 weeks or so. So with that, we will be now we're talking about short-term bias, short-term time frame. We talk about 1 to 3 days time frame. So in a short-term time frame, we will flip to a bearish bias to potentially see this minor corrective pullback scenario to take shape within its short-term trend that is still intact on the upside. All right, because it's still trading above the 20-day moving average. So as long as 40,690 short-term pivotal resistance is not surpassed to the upside, the Japan 225 faces the risk of a minor corrective pullback scenario towards 39,640/39,260. This is the near-term support level to watch. All right, if 39,260 is broken down, the next level to watch will be at the swing low area of 29th of February. We're so close to the former all-time high area that was printed in December 1989, 38,950/38,850. So that is the third support level to watch. If 39,260 gives way, However, only an hourly close above 40,690 will invalidate our short-term bearish bias for this potential minor corrective pullback scenario to see a squeeze up for a continuation of this impulsive up move. Next resistance level to watch will be at 40,980, followed by 41,475 / 41,660 Fibo extension cluster level. Hang Seng Index, or the Hong Kong 33, we call it, no change, continue to trade sideways, managed to hold above the 16,350 short-term pivotal support that we highlighted last week. So no change as long as 16,350 short-term pivotal support holds. We will still maintain that bullish bias on the Hong Kong 33 index. First resistance to watch 16,860. Above it exposes 17,010, 17,130, which is a Fibo extension cluster level, and as well as the minor swing high area of 28th of December and 2nd of January. Only an hourly close below 16,350 will negate this bullish tone within this medium-term counter trend phase that is still unfolding since the low of 22nd of January low. To see the extension of a minor corrective decline to retest the 20-day moving average, and as well as a minor congestion support zone 16,140 / 15,950. Okay, German 30, so no change. German 30 last Friday continued to shape that pullback, and the pullback managed to hold above this near-term support level that we highlighted, 17,680 / 17,730. But however, we do not want to tie it so tightly at this 17,730. We're still using 17,690 as my short-term pivotal support level to maintain this ongoing short-term bullish outlook on the German 30. First resistance to watch will be at 17,890. Above it exposes the next resistance level at 18,050, 18,100 level. Okay, Fibo extension level. Only an hourly close below 17,690 will negate this bullish tone to see the extension of this minor corrective decline to test the minor ascending channel support that I drew from the low of 14th of February, confluencing with the minor swing high area of 26th of February, acting as the same support level at 17,450. All right. US major stock indices, the US Wall Street 30, which is the Dow Jones Industrial Average, managed to hit the first near-term resistance level, 39,100, before shaping a minor pullback on last Friday. So still no change despite the fact that 39,100 didn't break out on last Friday. We'll be still using the key short-term pivotal support that we highlighted earlier, 38,770. So as long as 38,770 holds as our as our pivotal support level, we saw confluence with the upward sloping 20-day moving average, we will still maintain that short-term bullish outlook. Above 39,100 exposes the next near-term resistance level at 39,400. Only hourly close below 38,770 will invalidate our short-term bullish outlook to see the extension of a minor corrective decline to retest the 22nd of February minor swing low area at 38,430 / 38,360. We also potentially confluencing very closely to the upward sloping 50-day moving average as well. That is potentially soon to come to act as a support at this support zone at 38,430 / 38,360 in the coming days. Nasdaq 100, no change. Nasdaq 100 continue to pierce higher, shaping. Where is it? Nasdaq 100. Nasdaq 100 going to burst up higher. All right, with the RSI showing no signs of an exhaustion, going to shape a higher high as well, higher high in line with the price action. Okay, so it's hovering at the overbought level already. So potentially there could be a minor pullback towards this first resistance level that we highlighted earlier. Okay, that could be the pullback level to watch. So given the fact that I don't want to tight it so tightly at 18,220 as my key short-term pivotal support for today, so very clearly this is the former minor range stop that is in place since 13th of February. Tested one time, tested two times, tested three times, tested four times, break, pullback, shape that V shape push up on last Friday. So for sure, this is a much more significant support level, which will be my Titan key short-term pivotal support for today at 18,030. So as long as any potential pullback manage to hold above the 18,030 short Titan key short-term pivotal support level, we will still maintain that short-term bullish outlook on the Nasdaq 100. Next resistance level to watch 18,430/18,470, followed by 18,565, 18,626, upper limit of this medium-term ascending channel that is in place since 5th of January this year. All right, only hourly close below 18,030 will negate this bullish bias to see another round of a deeper minor corrective decline to retest the 20-day moving average, also acting as a near-term support level that's confluencing with the 29th of February minor swing low area, 17,810 level. All right, so net all in all, we'll still maintain all the major stock indices are still holding above that short-term pivotal support level, with except for the Nikkei 225, the Japan 225, which has almost hit the key resistance level already, and the RSI is actually flashing a bearish divergence condition, which indicates to us that last week steep up move on the Nikkei 225 has started to show signs of exhaustion, where right now the risk has increases for a minor potential corrective pullback scenario within a short-term uptrend phase for the Japan 225. That's the only the exception. All right. Now, spot gold. Okay, so like I shared with you, spot gold earlier on managed to shape that bullish movement on spot gold. So where's spot gold? Right, spot gold. Yeah. So spot gold on last Friday managed to hit our support level or resistance level at 2040, 2062, and going to pierce up and almost hit the 2090 level. So what's 2090 level is actually the minor swing high area of 4th of December and 28th of December that so far has kept previous up move. All right. So right now, spot gold itself has managed to hit this level, and given that the RSI is rather at the extreme overbought level on an hourly basis, so potentially it could shape a minor pullback. First pullback support level to watch will be at 2064 for sure. Okay, this minor range top over here that is in place since earlier part of January this year, but I do not want to use 2064 as my short-term pivotal support level. I rather use 2040, which has much more key elements that is pointing towards this level. Former congestion area bounce, retested shape that we call it a steep up move on last Friday, confluencing with the 50-day and close to the 20-day moving average acting as support as well, and as well as this minor trendline support that I draw from 14th of February. So as long as this pullback managed to hold above the 2040 short-term pivotal support level, we will still maintain that short-term bullish outlook on spot gold. So as XAU/USD, pardon me. So as long as 2040 short-term pivotal support holds, we'll maintain that short-term bullish bias on spot gold. Next resistance to watch after 2090 will be at 2011.7, followed by the all-time high level that was printed on the 4th of December at 2149. Only an hourly close below 2040 will negate this bullish tone to see another round of minor corrective decline extension towards the next support level at 2015, which confluence with the minor swing low of 20th of February and 23rd of February, and as well as the golden ratio of 61.8% Fibo retracement of this ongoing minor up move from the low of 15th of February to last Friday intraday high. Okay, very close. No, it's actually conferencing much more closer to the 67.4% Fibo retracement instead. Pardon me. All right. Now, WTI crude lastly. So WTI crude oil, like I shared with you earlier, this is the weekly chart. It managed to clear above this key medium-term resistance of 78.40. So with that, we'll be flipping to a bullish bias for today on WTI crude oil, West Texas oil. So the first resistance for sure to watch will be at 79.8. The first support level to watch, pardon me, will be at 79.80. But I do not want to use 79.80 as my short-term pivotal support level. I will use a slightly lower at the 78.14 level, which was the minor swing low area of 28th of February, 1st of March, and also confluencing with the 200-day moving average. So there's much more key elements that is pointing towards this support level at 78.40. So therefore, I'll be using 78.14 instead. 78.14 instead rather than 79.80. So as long as any potential pullback, so right now the RSI has really managed to exit from the overbought level, so potentially it could be in the midst of a minor pullback involvement right now. But as long as this minor pullback involvement managed to hold above the key short-term pivotal support at 78.14, we will flip to a bullish bias for West Texas Oil. First resistance level to watch will be 81.65, followed by 82.80/83.20 level, which is confluencing with the Fibo extension level as well, and as well as this minor congestion area of 31st of October and 6th of November. Only an hourly close below 78.14 level will invalidate this short-term bullish bias to see to actually state a invalidate or a bullish breakouts failure scenario on last Friday to see another round of churning for the price to reintegrate back below and retest the minor swing low area of 26th of February and 15th of February, as well as close to the 50-day moving average, all pointing towards a similar support zone of 76.20/75.75. All right. So net we'll be flipping to a bullish bias, short-term bullish bias for West Texas Oil, as long as any potential pullback managed to be held above the 78.14 short-term pivotal support level. Okay, so with that, that pretty much sum up for the short-term technical outlook. All right, so before we go, there's one key economic event to take note of over here will be the ongoing China 2 session. All right, 2 session. Okay, so what are these 2 sessions? So the 2 session will kickstart this week. So in fact, tomorrow will be key. Why? Because tomorrow, this Chinese 2 session, tomorrow, the China Premier Li Qiang will state China economic growth target for 2024. So very likely it will be around 5%, similar to last year. And what's important over here, he will actually announce what are the further details of capital market reforms to be announced tomorrow potentially, and as well as will there be any further stimulus that target consumption and technology stocks that are within that China President Xi pet project of sustainable development. So we know for sure that the China top policy makers has been keep on mentioning sustainable development. That means very unlikely tomorrow Premier Li Qiang will announce what I call a very massive stimulus package to actually jumpstart the Chinese economy, but rather stimulus that are still remains targeted to various sector of the Chinese economy instead. Very likely that is pointing towards a boost to domestic consumption, perhaps tax breaks, consumer tax break, and as well as certain policy that are targeted towards technology stocks that China wants to actually bring up, especially that is towards the potentially the semiconductor industry. Why? Because semiconductor industry is also one of the pet project of sustainable development that has been promoted by the top leadership of China, which is i.e. presidency. So something to look out for during this China policy meeting, that the most important one will kickstart tomorrow morning, where President Li Qiang will actually highlight China economic growth target for this year and how China is going to achieve them, especially on that potential targeted fiscal stimulus plan that likely targeted on the consumption side and the technology side sector, especially the semiconductor sector. All right, so with that, that pretty much sum up for today's Daily Dose of Market Insights. I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.